My agenda for today is as follows. What is money? We'll think about what it actually is. Sometimes a question that seems like an easy question, but actually a bit more complicated than it might first appear. And what is credit, and what's the relationship between them, which is very important. What does mainstream economics say about money and credit? How are they conceptualized? And then what do alternative theories talk about? And what are the challenges posed by the role of money and credit and finance in capitalist economies? And then at the very end, I'll talk briefly about alternative policy options to the ones that we have today. And Andy will certainly pick up more on the policy challenges, particularly in the light of the financial crisis of 2008, which of course was inherently a crisis of money and finance. So, firstly, what is money? What do we mean by money? Now, if you read a standard economics textbook, you'll probably find some kind of account of money based upon its functions. What does it actually do in the economy? And these are the standard functions that are proposed. It's a unit of account. It's a way of actually accounting for the value of stuff, measuring things. You can compare the value of a couple of chickens with a cow. Money enables us to compare things. It's a means of exchange. It enables us, because of this accounting function, it means we can exchange more easily with each other. It's also a store of value. It's a way of keeping wealth in a form that's highly liquid. You owe somebody something, you can easily pay them off with money. And it's also a means of final settlement. And by that I mean you cannot get anything else for money except more money. If any of you have a Bank of England note in your pocket, you'll see that it says something, a sterling note in your pocket, you'll see it says something like, I promise to pay the bearer on demand the sum of £5. But actually, if you go to the Bank of England, they won't actually give you £5 of something. They will just give you another note that says, I promise to pay the bearer of this another £5. So actually, money, it's a final means of settlement, particularly in countries like the UK, which has a sovereign currency and a sovereign central bank. You can pay for everything with it. It is not legal for a shopkeeper to turn you down if you attempt to pay for something in sterling. Now, the conventional, mainstream, neoclassical account of money that again you will find in textbooks is that it is a convenient alternative to barter. Essentially, the theory of the emergence of money, according to this, is that money emerges out of the need to exchange stuff with each other more efficiently. So basically, rather than me gathering together 25 chickens in exchange for your one cow, because I need milk and you need chickens or eggs, we can just exchange some money to the equivalent to the value of that cow or that chicken. It makes life a hell of a lot easier, and money emerged as a commodity which had certain properties, such as being highly portable, such as being highly durable, unlikely to sort of break down, and such as being sort of easy to account for things, essentially. But there was nothing special about it as a commodity other than it's easier to exchange it for things than other things are to exchange, essentially. The classic sort of image in our head we had of money is gold coins, or highly portable, highly durable, fungible, etc. And money itself, in this approach, is essentially seen as a veil over the real economy. And the real economy involves the exchange of actual goods and services, of actual stuff, labor, capital defined not as money, but capital as machinery, as stuff that enables us to do things more efficiently, essentially. Money is just a sort of oil that essentially lubricates the economy, makes it more efficient. It's an optimizing optimizing tool of exchange. So the emphasis is very much actually on that first definition, that first function, money as a means of exchange. Now, this concept of money as an emerging commodity that emerged to enhance the efficiency of exchange is right there, square, front and center in Adam Smith's classic work, The Wealth of Nations. In order to avoid the inconveniency of such barter situations, every prudent man in every period of society after the first establishment of the division of labour must naturally have endeavoured to have next to him a certain quantity of some one commodity or other, such as he imagined few people would be likely to refuse in exchange for the produce of their industry. And there we have some industrial people making things, all wanting some money next to them in order to be able to exchange those things. Now, if you look at textbooks, what's quite interesting is the evidence for this theory of the origins of money as a commodity to support efficiency as coming out of barter is rather weak. There isn't actually strong historical evidence to support this theory. So here's a few quotes, and what you'll see about these quotes from really, textbooks that have sold literally hundreds of thousands of copies all over the world. Some of you who studied economics already will probably be familiar with them. But all of them have this word imagine in them. So to see that a society benefits from a medium of exchange, imagine a barter economy. Imagine the difficulty you would have today if you had to exchange your labour directly for the fruits of someone else's labour. One can imagine an old-style farmer bartering with a blacksmith, etc., etc. It goes on and on. So what we're talking about here is a hypothetical, right? Imagine this, imagine that. In reality, it's rather different, and I'll come on to the different approach. But let's stay with this commodity theory of money as emerging to support greater efficiency of exchange for the moment. What about banks in this scenario? What's the role of banks under this commodity theory of money? Well, the basic idea is that although money is portable, relatively easy to carry around, actually it is quite inconvenient, especially if you're rich and you want to buy lots of stuff, to carry all of these gold coins around with you. And actually it's a lot easier to put them somewhere, an institution, to keep them safe on your behalf. And banks play that role, essentially. And if you read some history, the goldsmiths were the first fractional reserve bankers because essentially the service they offered was to safekeep your gold and issue you with credit notes that later actually were used as to exchange and to buy, could be used to buy things on a very informal basis. And this sort of happened in medieval times in a number of different countries in Europe, actually. But anyway, the function of the bank is to hold money safe. But the other function of the bank, of course, once the bankers realized that actually all these people who stored their gold with them, not all of them would want all of their gold back at the same time. In fact, the bank would be able to keep most of the gold in the account and would only need to let those people that came in to take small amounts, only a very small proportion would need to be lent back out at any time, or given back out. They thought, hang on, there's a business model here. We can actually lend that excess gold that we have to other people who need it now, who need it today, rather than those savers who don't need all of it today, essentially. And that is the origin of fractional reserve banking in a crude nutshell. And the idea in the textbooks very much is that actually banks take money from those people who need less of their savings, their money now, and lend it out to people, companies, small businesses, running nice little cafes, who need the money now in order to invest in production, in capital investment, etc. And this enhances the efficiency of the economy, obviously, because you're not having this money just sitting around. The bank's actively investing it or lending it to be invested. And from here you get this famous equation in economics that savings are equal to total investment. So basically, banks are intermediaries in this conception, this sort of mainstream convention. And we can picture this with the following, again, a highly simplified graphic. This is the circular flow that those of you, again, who studied economics will be familiar with. Firms pay people's salaries, people use that money to buy stuff from those firms, and that money goes back to the firms where they can invest and again pay salaries, and round we go. The role of the bank is essentially to provide an additional source of funding or financing for those workers. They're intermediating existing money. Now, of course, one question you might ask is, where does money come from in the first place? Well, the conventional account would have it that, as I said, certain commodities just naturally become more used to exchange for other things. Then we get gold. You need somewhere to store the gold. Then you need the banks. That's how the sort of historical imaginary account goes. This gave rise to what you might call pre-crisis orthodoxy, when we take it out to the bigger picture around, how do you actually regulate the financial system? How do you manage the financial system? And as I said, banks and credit and money are essentially seen as a sort of veil over the real workings, the real exchange economy. And you have this sort of what's called the classical dichotomy in neoclassical economics of the real economy, where real stuff is exchanged, and then the financial economy, which is a veil, but doesn't really have fundamental causal impacts on the dynamics of exchange. And the other key point, really, when it comes to finance is this idea of the efficient markets hypothesis. This was first developed by Farmer in 1970, recently won the Nobel Prize. Basic idea of it is that if you have highly competitive markets and the stock market is competitive, that the price of any particular stock reflects all available information, publicly available information, instantaneously, effectively, in that price, so that no one market participant, no one hedge fund manager or whoever it might be, can beat the market. The market is, and that's what is meant by efficient, essentially, that the price of the stock market reflects all available information instantaneously. And there's weak and there's strong versions of this, but that's the basic idea. And this gave rise to the idea, really, that governments and the state, central banks, should be very careful about interfering with that natural process of price discovery in financial markets, and also in the banking sector, because the danger would be that intervention would lead to the loss of this efficient markets dynamic, and the danger would be that governments supporting one particular sector over another leads to inefficiency and inefficiency of capital allocation. And so from the 1970s onwards, particularly from the 1980s in this country, in the US, there was this deregulation of the financial sector. Banks used to, for example, be dedicated towards particular sectors of the economy. There used to be restrictions on interest rates that banks charged. There used to be credit guidance policies to encourage credit to flow, money to flow this way or that way. But all of this began to be loosened, as I've already talked about, I think, in week 3. So, in terms of monetary policy, and monetary policy is essentially how we sort of try and control the amount and price of money in the economy, the quantity and price of money. Economists converged on this idea that actually interest rates were the key tool to determine the amount of money that flows into the economy. For a period during the late 70s and 80s, there was an attempt to actually control the total amount of money that goes into the economy by targeting a monetary aggregate. This is monetarism. But that was found to be very, very difficult. And so by the 1990s, there was agreement, a consensus around the idea that it was better to try and control the amount of money by targeting an interest rate where the market would clear, what's called the natural rate of interest. And this would be the rate where savers and borrowers would find a sort of consensus, an equilibrium consensus around that would ensure, again, this efficient optimization of capital allocation. There's never been any proof of the existence of a natural rate of interest, but it remains the most, probably the most important theoretical idea in monetary economics and macroeconomics more generally. The other key part of this pre-crisis consensus was a strict separation between monetary and fiscal policy. And Stephanie talked a bit about this in week 2, but the basic idea was because of the danger of inflation and the lack of trust in governments to actually create money themselves, that there should be this strict separation, and the state should be restricted from directly creating money. This should be left to central banks who are independent of the state and independent of the government of the day. So monetary financing of activity was prohibited. All of this seemed to make sense in the context of the 1990s to early 2000s period, because we saw this quite astonishing period, really, where you had relatively high, not that high compared to the 1950s and 60s, but relatively strong growth, around sort of 3%, and at the same time, low inflation. So inflation also around sort of 2 or 3%, in most cases in advanced economies. And this hadn't really happened before during earlier periods. And so it was felt that these policies had achieved something really quite impressive, that we sort of solved the problem of inflation and growth, and how to make those two key macroeconomic variables work effectively. And so we had these declarations of the end of boom and bust, Gordon Brown very famously in this country, and the period was actually called the Great Moderation, and there's been lots of papers written about this Great Moderation. But this is not actually how it works, and obviously the financial crisis rather brought this consensus to a rather disastrous halt. And people, of course, after the crisis suddenly realized that maybe this underlying theory of money was not right, was not correct, that actually banks perhaps had a slightly different role. They weren't just pure intermediaries, that money and credit was not just a veil over the real economy, but actually had bigger, stronger impacts. And there was a turning back to some older thinkers on the role of money in the economy. And one of those was Joseph Schumpeter. And Schumpeter and Keynes, just a few years after him really, didn't accept this classical dichotomy of the monetary economy here and the real economy there. They actually argued that rather than being intermediaries, banks' key role was to create new money and new credit and purchasing power in order that the economy could grow, could expand. So quite a different conception of the role of banking and money and credit in the economy. So let's return to our circular flow that I introduced before. That's the sort of classical conception of what's happening. But then if banks are actually creating money in the act of lending, our diagram should actually look more like this. We have the banking sector, and it provides credit, loans to firms and to consumers to enable consumption, to enable investment in particular and production, to pay wages and salaries, and to support the circular flow. But of course, if banks are creating new money via lending, then both firms and workers will have to pay interest on those loans. And they will have, in other words, there will be debt servicing in the economy. People will have to pay back their debt as well as doing the other investment and purchasing. And suddenly it was realized, I think, that this was a more accurate representation of what was going on, and it was much easier using this approach to think about what happened during the financial crisis, where we had an excess of credit for certain types of activity relative to workers' and firms' abilities to grow the economy and pay back the debt. So I'm just going to go through now, before returning to the broader picture, the actual process of money and credit creation, because I think it's really important that everyone understands that. And unfortunately, this is not something you will be taught most likely in your first or second year economics course. It's just not seen as that important. I think it is extremely important. So this is a simplified bank balance sheet. Banks have, like any firm, assets from which they derive a flow of income, and liabilities, that is what they owe to other people or other organizations. And the key thing is that those assets and those liabilities must at all times balance. Otherwise, the bank is in danger of either insolvency or not being liquid. So on a balance sheet, you have loans, which we understand. You have deposits. We deposit money in the bank, as everyone knows. But then you have some other types of assets and other types of liabilities. And I'll talk about those shortly. Where is money in this? Well, it's here. A bank deposit is money. And when a bank makes a loan, it creates, well, I'll show you exactly what happens. Basically, you have money as a deposit, and you also have money as cash and central bank reserves. Now, the act of creating new money, first you sign a loan with the bank, and the bank creates a new asset, so that the customer loan, the asset side expands, and at the same time, the bank credits your account with a new deposit. Now, that deposit is money. It's an IOU from the bank to you, which you can use to pay your taxes, to buy the newspaper in your local shop, to give to your friend if you owe them money. But it is a bank IOU. Okay, it's not anything else. It's a bank IOU, and of course, the bank's IOU is underwritten by the state. So that's the act of creating money. Both sides of the balance sheet have expanded, so they are even, as I said before. You then spend your money on whatever you borrowed it for. You buy a car, or you buy something else that you need. That reduces the liabilities in your bank's balance sheet because they go to another bank. Okay. Now, when you transfer your deposit, what happens is the bank, which has reserves with the central bank, transfers central bank reserves to settle your payment with that other bank. So essentially, we have two circuits of money. It's the best way to think about it. We have a circuit involving me and you and the other payees, for which we use bank IOUs to settle our payments. But there is another circuit involving commercial banks and the central bank. And commercial banks have to settle with each other via their account at the commercial bank using central bank reserves. Central bank reserves are basically electronic cash. They're equivalent to the notes that you pull out of the commercial bank, but they are used by commercial banks to settle with each other. Now, at the end of the day, the bank has to replenish its reserves. So if it's had an outpayment, pay another bank to help you buy your car, reserves will have moved over to that other bank, and that bank, your bank, will need to replenish its reserves to ensure it's solvent. So it will do that by borrowing from other banks in the interbank market. And you've heard of the LIBOR crisis. That's the London interbank market. That's what it stands for. It's banks borrowing and selling to each other those central bank reserves to ensure they have sufficient liquidity at any one time. And of course, again, that additional borrowing on the interbank market increases the liabilities of the bank. And again, the assets and liabilities are even once more. Now, to make that a bit clearer, because I know it's a bit of a complicated thing, this is a visual that tries to represent what I've just been talking about. Essentially, this clearing process happens, is represented in the top diagram here. This is the big sort of 6 banks in the UK. They're clearing by swapping reserves with each other during the course of the day. They also allow you to withdraw cash. Of course, you can withdraw some of your electronic IOUs as cash. That is also a function of the banking system. And then overnight, those commercial banks trade with each other, buy and sell reserves with each other to make sure they've all got sufficient central bank reserves to maintain their liquidity, essentially. Now, what the central bank does is it basically decides on the interest rate of those central bank reserves in the interbank market. Okay, so when the central bank raises interest rates, it's effectively raising the cost of funding for commercial banks to borrow those reserves from each other in the course of a day or overnight. Now, if it raises the idea is basically if it raises the cost of those reserves, the commercial banks will pass on that cost to customers when they make loans, essentially. So you raise the interest rate, the policy rate that you will hear about on the news by 1%. Typically, commercial banks will add that to the cost of borrowing your mortgage or your credit from a commercial bank. And of course, by raising the cost, the idea is you deflate demand because money costs more, you borrow less from the bank, there's less money in the economy, inflationary pressures are reduced. And the opposite, if you cut interest rates, you encourage, again, that cut is passed on by the commercial banks to the public via this second circuit of money, and you increase the amount of money in the economy. That is the basic idea of monetary policy. How do banks become insolvent? Well, what happens is the loans that they've made are not paid back. And if enough of those loans are not paid back, the result is, if more loans are not repaid than the bank's equity capital down here, which Andy will talk about in more detail, this is essentially, capital is essentially the money that the bank holds on to in case loans default. Okay? So again, because the amount of loans is larger than the bank's equity capital, you see the dotted line, that amount's larger, the bank will become insolvent. How do banks become illiquid? Well, in that case, customers withdraw deposits at a faster rate than banks can sell their liquid assets, bonds, for example, that hold government bonds or corporate bonds, which means the bank can't reduce the asset side of its balance sheet as fast as the liability side of its balance sheet is falling. And if that happens, the bank will eventually become illiquid and be unable to continue. It won't be able to give out any more money to its customers, and it will essentially have to go into receivership. So that's essentially how insolvency happens and how illiquidity happens, even though banks can create money, which is kind of an obvious question you might sort of ask. Of course, people won't borrow from a bank if they think it's illiquid or insolvent, so the bank won't be able to create the new deposits it needs to fund itself. And no other bank either will accept payments from it if it has lost confidence in its solvency or its liquidity. So you have this very strong pro-cyclical self-reinforcing dynamics that can lead to this loss of confidence, which is what happened during the financial crisis. Now, let's just go back to this credit theory of money that I talked about earlier with Schumpeter and Keynes's work. As I said, the main driver of lending in this scenario is confidence. It's not to do with, fractional reserve banking is sort of technically not a very good term to describe our system, because it implies that banks can lend out some fraction of the reserves that they hold, the gold that they hold in their accounts. It used to be a bit more like that, but today we have what's called endogenous money. Essentially, a bank can create new money without needing any savings or deposits. It actually creates the deposits in the act of lending. So it's endogenous in the sense that it's dependent on the confidence of the borrower, more demand for money, and the confidence of the bank to lend. So the confidence of the bank in the solvency of the borrower. Okay, So it's driving the economy, or the economy is driving the lending. And again, this dichotomy between the real and the financial falls apart under that kind of approach. So capitalist systems are driven by endogenous credit-driven cycles, and particularly they're driven by asset prices, because that rising asset prices, rising house prices, or rising prices of other types of assets creates more confidence, leads people to demand more credit, leads banks to lend more credit, and vice versa when things go bad. Now, I've already talked about the final point in week 3, the idea that actually different types of credit can lead to different types of economic outcomes. And that's what I just want to focus on briefly now, is the sort of historical dynamics of this allocation of credit by the banking system. If banks can create money essentially out of nothing, it's very important we think about what they create that credit for, right? Now, this chart is from a working paper that it's actually 2018 working paper that I just finished with some co-authors that you can download from the IIPP website. It's on the reading list as well. But what this shows is that the total amount of bank credit relative to GDP, the left-hand axis, since 1970. The non-dotted line, the black line, shows the total. And you can see that's risen substantially from about 60% of GDP in the early 1970s to around about 100% today. So it's basically almost doubled. And in fact, if you take it up to 2000 and present day, it has doubled. But the allocation of that credit has changed dramatically. The dotted line shows a proportion of that credit, the share of that credit that's actually supported non-financial firms. So again, this classic notion that what banks do is they give money to firms and firms invest in the real economy and pay their workers, and round we go. That's actually reduced. The share's reduced from almost all of that credit supporting firms to, around 60% of that credit supporting firms to 40%. So dramatic change in the role of the banking system in terms of shifting from supporting firms to supporting other stuff. And the main other stuff, as I talked about in week 3, is real estate assets, mortgages. And here you can see a chart showing this huge growth in mortgage credit relative to non-mortgage credit, which again is mainly lending to firms, from around about the late 1990s. And you remember me arguing that that was the main reason for the housing affordability crisis that we've seen. Now, the basic argument here is that from an economic perspective, we want more credit supporting firms to invest, to pay workers, to innovate, and you can have this positive cycle of bank credit. The credit supports investment, GDP transactions, it increases productivity, leads to higher wages, people buy more stuff, there's increased demand for goods, businesses use that increased profits to expand and borrow from the bank to expand further, etc. That's the sort of productive circuit of credit. But there is another circuit, and that involves lending against assets, particularly mortgages, but also financial assets increasingly. That tends to inflate the value of those assets because it's not leading to an increase in production in the economy. It's just money flowing into land or a financial asset, a stock, without leading to any increase in productivity. That leads to, because asset prices are rising, that leads to expectations of future asset price rises, and people want more of that thing. See house prices going up, better get on the housing ladder, right? So there's more demand for asset market credit. But there's a sort of secondary, more negative circuit from increase in asset market credit, which is an increase in debt relative to the growth of the economy. Asset prices rise, your house price goes up. You need bigger loans in order to buy a house, and thus you're paying more interest, and eventually that is going to weigh down on your ability to buy stuff in the economy as the debt servicing ratio debt-to-income ratio increases. This leads to reduced consumption, meaning there's less money flowing to firms, meaning there's less demand for productive credit. And in firms themselves have started turning towards buying up land and real estate, or getting loans to buy up land and real estate, or using money to buy other firms to inflate their share prices, what Bill Latzanik was talking about, the share buybacks. Again, with the purpose to inflate asset prices rather than to invest in the real economy. Of course, this leads eventually to stagnating wages, which means people again need to borrow more in order to buy stuff, including houses, but even to pay their bills. So that's, I think, my view is we're sort of shifting dangerously towards that more negative circuit of credit. And this is borne out in the data. This shows UK domestic banks, the composition of net lending by broad industrial sector at 4 points in time since 1986. And what you see there is that back in 1986, almost 40% of all bank lending was supporting, this is the UK, it's UK banks only, was supporting non-financial firms, the real economy. But by 2018, this had fallen to less than 10%. So now less than 10% of all UK bank loans in this country actually supports non-financial firms. So that sort of textbook story of what the banking sector does is no longer true. But we've seen this enormous growth in lending for domestic mortgage in the purple, and also commercial real estate, so lending to firms to buy up real estate, to buy up land. That's also increased by about 3 times. And we've also seen an expansion in the financial sector lending. And a lot of this is loans to asset managers or to hedge funds or to other financial intermediaries, again, to buy existing financial assets, this sort of trading, which Adair Turner calls essentially socially useless activity, because all it does is turns over existing assets without actually creating any value in the real economy. So that's a sort of snapshot of the UK economy. Andy's going to talk more about this, but I just want to touch, before I finish, a bit on the sort of post-crisis reform agenda. The focus of this agenda has actually not been on this allocation problem. Rather, it's been on how do we prevent another financial crisis by reducing the risks in the financial sector. Okay, that's been the sort of overarching view. And the key mechanism by which that's been done is to force banks to hold more capital. So that little square at the bottom of the right-hand side of the liabilities that I showed earlier. And there's been a view essentially that these shocks, these financial shocks, which the financial crisis was an example of, can be dealt with by banks holding more capital. But there's not really been such an acceptance that actually the banking system itself can endogenously create these shocks by excessive lending against, for example, assets rather than lending to firms. There's been very little examination of that problem. Now, we've had the ring fence reforms in the UK, where they try and separate off investment banking from retail banking, so banks can't use their profits from speculative trading to fund their lending, which is a good thing. Been a bit watered down by the banking system. And there's been these bail-in rules to try and prevent the taxpayer taking the hit when banks become insolvent. Monetary policy has also changed quite a bit. Financial stability has risen much further up central banks' priorities. So price stability was always there, this focus on inflation, but now they're much more focused equally on financial stability. But there's still this very strong separation between monetary policy and fiscal policy. Probably the most radical new tool that central banks used, was quantitative easing. Now, what is quantitative easing? Well, it's basically the central bank buying up assets, financial assets, from financial corporations, typically pension funds and insurance companies, and typically it's been government bonds that they've bought, replacing those government bonds with central bank reserves, which leads to an increase in money in the economy. But it only leads to an increase in money in the accounts of commercial banks at the central bank. Okay, so it's an increase in the reserves, and the hope was that that would translate into an increase in lending by commercial banks, because the concern was that these commercial banks were worried about their liquidity. The interbank market had broken down. Interest rate on the interbank loan had shot right up. Banks weren't lending to each other, and by flooding the interbank market with these reserves, the hope was that would increase confidence in the banking sector, and they would then start lending again. It didn't really happen like that. Sorry, this just shows you interest rates in all the major advanced economies collapsing to zero without leading to the recovery that we all expected, suggesting that the interest rate tool wasn't working for some reason, essentially. And this is quantitative easing. And what I was just talking about there was the top graph, this increasing of banks' liquidity by flooding the interbank market with reserves. But of course, there's other channels. The theory was there's other channels here that if you buy up government bonds from pension funds and asset managers, you're taking away the most safe form of asset that they have, and the hope was that they then invest in corporate bonds. They buy bonds from companies, which are riskier, but give you a higher return, and that would support the recovery, that the cost of capital for commercial organized for firms would be reduced, and they would then spend more money in the real economy. And there was also an argument that QE would have a wealth effect. It would increase it results in capital gains on assets, including housing and in stocks, because the cost of capital is cheaper for firms, and people would then feel richer. And the idea is that they would select this top option, they would invest more in production, or they would increase consumption in the case of households. But of course, there's more evidence that they either played it safe, just sat on the money, including the banks sitting on the money rather than lending more, or that they would just invest in existing assets, including property or commodities. They would use that extra money to, as I said, buy existing assets rather than invest in the real economy. And that does seem to be what happened. So this chart shows UK bank lending from 2004 to 2014, and you can see this massive collapse in lending from the financial crisis from 2007 onwards. It's SME lending, total lending, secured lending to households, mortgages. Then QE comes in around second half of 2009, and it does stop the rot. This collapse in lending does stop, but there isn't a recovery back to the levels that we saw in the early 2000s, suggesting that QE wasn't leading to, or it didn't help a recovery. So the problem is that monetary policy seems to have run out of steam. Despite QE and despite zero interest rates for now 10 years, basically, we've had record low interest rates for a record amount of time. We haven't seen the recovery we expected. And there's this danger of a debt trap, essentially, that these very low interest rates, while they would appear to be a good thing, if banks and people are just using the very low rates to buy more assets, to buy more property with more debt, then you're not actually reducing the amount of debt overall in the economy, and you're not growing the economy fast enough to deflate away that debt, which I think was the hope. So you're sort of stuck in this kind of high debt, low growth stagnation that is a major issue, sometimes called secular stagnation. Banks, many people feel, are still very undercapitalized. Andy will talk more about this. And that key point 5, that credit is still mainly allocated to existing assets rather than new assets. And this is the Bank of International Settlements, which is the bank of banks, essentially, based in Switzerland. Countries could at some point find themselves in a debt trap, seeking to stimulate the economy through low interest rates, encouraging even more debt. But this ultimately adds to the problem it's meant to solve. how do we get out of this mess? Well, these are some of the policy reforms that I've worked on in the past, and I'm working on at the moment. Credit guidance, this is where the central bank financial regulator is much more proactive in actually steering credit to particular sectors of the economy. Now, this was used on a sort of routine basis in the 1950s and 1960s in advanced economies. It was used by almost every European country to support high value added sectors, to support industrialization. It is still used today. You won't be surprised to hear in China. They have a quarterly monetary policy bulletin which lists all of the sectors that they are providing cheap or very low interest credit to. If you can look at it on the website, it's translated into English. They do stuff like credit support for shanty towns, for green energy, for building bridges, obvious kind of stuff that actually helps the economy. It's become taboo in advanced economies since the 1990s, essentially. And I'm in conversations with central banks about this to try and support the low carbon transition, but it's a really challenging area because this efficient markets hypothesis is still very strongly embedded in policymakers' minds. Use QE more effectively. Use QE to actually support building new houses or support the green energy transition. For example, by financing state investment banks that actually are dedicated to these particular sectors, the Green Investment Bank, the Business Bank. We have these structures already in this country, but there's insufficient finance because government doesn't have, it's not perceived to have enough money to support them. Then there's also structural reforms. In the UK, since 1960, we've had this incredible consolidation of the banking sector. So we went from having about 25 medium-sized banks back in the 60s, often with a strong regional focus, building societies, cooperatives, a diverse system of banks, to having these just 5 now, sort of 6 massive shareholder-owned banks that are basically focused on short-term quarterly returns. Maybe what we need is greater diversity. Maybe we need stakeholder banks that are actually owned by their members, local or regional economic actors, that are less focused on short-term returns, that de-risk their loans, not by demanding collateral, usually in the form of real estate, but by building relationships with those firms over time, understanding the local or regional economies that they're in, giving them some slack in the bad times because they've built up that relationship of trust. Essentially reducing the asymmetry of information that always exists between the borrower and the lender by actually really understanding the business. In contrast, the shareholder banks will typically just put your details into a centralized credit scoring system, and yes or no will be the answer. Computer says yes, computer says no. And basically, if you don't have 10 years worth of decent figures, or you're not prepared to put up your house, you won't get the loan. To put it crudely, very different type of model. And the evidence suggests that these stakeholder banks typically are more likely to lend to non-financial firms, whereas the shareholder banks have shifted towards mortgages and financial assets. And the other thing that IIPP particularly has been working on is state investment banks, public banks, development banks, got different names, but essentially these are banks that are, again, dedicated to supporting particular sectors of the productive economy. And we've been working very closely with Nicola Sturgeon to help set up the Scottish National Investment Bank. It's the first major new investment bank in the country, if you don't include the rather very small funds that are the Green Investment Bank and the Business Bank. Yeah, that's been we've helped design what that bank should look like, and we're currently working with them to make it happen. You can find out more about our research there. I'll finish there, just to leave you with this quote from dear John Maynard. Credit is the pavement along which production travels. This is this monetary theory of production. And if bankers knew their duty, they would provide transport facilities to just the extent it is required in order that the productive powers of the community can be employed at full employment. So that's an inspirational quote from Keynes. Thank you very much.